Hey, how's it going, everyone? In this video, let's go ahead and talk about Papa John's, ticker symbol pizza. I mean, that ticker symbol alone, amazing. Because right now they're trading for about $46 a share. Their 52-week low is $46.20. Forget about that, because this stock right now is trading at its 5-year low. So back in 2019, they used to trade for roughly $46 a share, and right now they're $46 a share. So I'm trying to figure out, is it a good time or a bad time to jump into Papa John's? So in this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or a disgusting dividend stock. And before I forget, back in January of this year, they used to trade for about $77.80 a share. However, since then, they have just been tumbling. So I'm going to do a deep dive and we're going to investigate and figure out what's been going on. So this is a channel that is focused around dividend compounders. So the first thing that we're going to be looking at is their dividend profile. So their current dividend yield is sitting at 3.9%, which I think is pretty good. It's pretty juicy. But is it sustainable? Can they actually keep paying for this dividend? So when we look at the dividend payout ratio, it says no. It's pretty high. What we want to see in an investment or a company that pays a dividend is a dividend payout ratio that's less than about 70 to 75. And depending on the sector and industry, sometimes it can go a little higher and sometimes a little lower. But for a food company to be at an 82% payout ratio, I just don't know if this dividend is going to be sustainable going forward. And if it is, they're probably just going to freeze increasing the payments, meaning it's just going to stay at 46 cents a share every quarter, which in their company DNA and past history from 2017 all the way to 2021, the middle of it, they did not increase their dividend payments at all, meaning every single quarter you got paid 23 cents a share every quarter for that time period. So I think because right now their stock price is taking a hit, they cannot afford to increase the dividend next year or next quarter. So I think from my intuition and thinking, Papa John's is going to continue to pay 46 cents a share until their finances and their stock price recovers, which is such a sad story to see because for the past 3 years, their dividend growth rate, what Papa John's has been increasing this dividend payout by, is 25%, which is beautiful and what you want to see as an investor, but they've just been going through it. So I would say their dividend profile is kind of icky. So moving right along, we want to know, is Papa John's even worth investigating, right? So what is their 15-year total return? Back in 2009, Papa John's used to trade for $10 a share right after the Great Recession. So since then, it's been a 344% return from June 2009 to June 2024. So yes, on the basis of their total returns, it's looking okay. But how about if we compare it to the market? So when we compare Papa John's to the market, which right here is the S&P 500, the ETF VU, with $10,000 invested in January of 2015 up until today, with Papa John's, your total return would have been negative 0.28%. Meaning your $10,000 from January of 2015 would have transformed into $9,700. On the other hand, the market, if you would have just invested that $10,000 into VU, well, then it would have transformed into $31,500, which when you break that down, the annual rate of return, that's 12.8% a year. So, Papa John, things aren't looking too good. And if we compare Papa John's to their competitor, which in this case is going to be Domino's Pizza, the exact same parameters and variables, with $10,000 invested January of 2015, Domino's, that would have transformed into $60,500, which is a CAGR of 20.8% year over year. So with Domino's, your money would have grown by 600%. With Papa John's, man, it's not looking pretty, right? Your money would have shrink. So it looks like when we think about their total return for the past 15 years, it's looking pretty good. But for the past 10 years, not so great. So the next thing that we're going to be looking at is the shares outstanding. We want to figure out if the company is issuing more shares and diluting the shareholders, or are they buying back shares? So let's see. Back in 2009, Papa John's had 56 million shares outstanding. And since then, they have been buying back those shares, except during the pandemic when it looks like they paused buybacks and then they actually had to issue more shares to stay afloat. And then after this 2-year period of issuing more shares, they have been buying back the shares, which brings us to today. Now there's about 33 million shares outstanding. So going from 56 million to 33 million, okay, finally, Papa John's is doing something right. All right, so the next thing that we are going to take a look at is the business model and talk about their economic mode. We want to figure out how do they make revenue. So Papa John's is in the business of selling pizza in a B2C format on surface level. However, they operate their business from a franchise supply chain, having entrepreneurs who franchise a Papa John's store to do all the heavy lifting for the corporate office. Also, they have their own ingredients network that they refer to as the commissary, that all franchisees have to buy the ingredients and products from. So one source in order to keep that consistency across the board. And I think this is a good thing because corporate buys the pizza sauce, toppings, and dough materials in bulk from the manufacturers that give them a huge discount. Then Papa John's can pass those savings down to the franchisees so that those franchisees don't have to go out and individually source, marinara sauce or flour. So from the franchisees running the stores, they have to pay royalty fees, marketing fees, and other expenses to corporate Papa John's. And that's a part of the revenue that Papa John's posts. It's similar to the McDonald's and Domino's business model. And as of the first quarter of 2024, Papa John's operates a total of 5,914 stores globally. And out of these, 536 are company-owned stores located in North America, and 117 are company-owned international stores. So I think what's happening is they build a company store, make sure that it's running efficiently, and the margins and profit is there, and then they sell it off to a franchisee, unless a franchisee wants to start one up from the ground up. The majority of the stores are franchise-owned, which accounts for 2,911 in North America and 2,350 internationally. This franchising model allows Papa John's to expand its presence globally while sharing operational responsibilities with franchisees. So when you think about Papa John's, they have two different modalities. They have the traditional format, the Papa John's that you think of when you think of Papa John's, and then they have the non-traditional format. And a franchisee can actually pick between the two. And depending on which one they want to operate, it comes with its different fees. However, one thing that's common with both is that they have to pay 8% marketing fees, which for my understanding of the restaurant quick service industry is pretty high. Because usually restaurants, they charge like 3, maybe 2.5%. But for Papa John's to charge 8%, that's a margin killer. Right? So in January of this year, they actually announced a Back to Better 2.0 strategy, which was a comprehensive plan focused on bringing those margins and profits back to the franchisees. So instead of an 8% marketing fee, now they're charging the franchisees only 6%. And believe it or not, the Papa John's that you know and love in the UK or in America, it pales in comparison to its international stores. For reference, as I ramble on and on about their business model, I'm going to just show you a sample of some of their menus from these other countries. So this one right here is the menu for South Korea. So their franchise model is very similar to McDonald's and Domino's. However, unlike Domino's, Papa John's tries to paint a picture of being premium pizza. Right? With Domino's, we think about a college student or a budget meal that can feed a family. But with Papa John's, they like to see themselves as being premium. And so they have a target demographic of affluent customers. So they're not trying to appeal to the budget frugal customer base like Domino's or Little Caesars. As such, when it comes to Papa John's, they don't throw around promos and coupons that sell pizzas at a loss at like $5.99 a pie. But consequently, because their pizza prices are higher than the competition, they are unfortunately seeing their volume of traffic decrease. I mean, look at these pizza prices right here, right? I think this is measured in one. So a premium grilled bulgogi pizza. For a large, it's 29,501, which is roughly $29.50. And I don't know about you, but that's a little high for one box of pizza. Now I'm going to show you what Guam's Papa John's looks like. So let's take a look at their menu. I mean, I would say it looks pretty similar to the US. They just got the Hawaiian, chicken bacon. Yeah, this looks pretty similar. I just have a feeling between Spain and Turkey, one of these is going to have an awesome menu. Let's just go with Spain. As you can see, depending on the country, like Papa John's just looks different, right? And I think that's cool because they're trying to appeal to the customers depending on their preferences. But unlike Domino's, they just don't have that consistent brand and logo. But whatever, maybe I'm just nitpicking as a marketing guy. Let's go ahead and click their menu so you can take a look at what they've got going on. And on the note of their customer base, they have over 32 million people signed up for their rewards program, which through their analytics shows that a little over half of their revenue is generated from their customers. So taking a look at their top line, back in 2019, it was $1.6 billion. Fast forward to today, now it's $2.1 billion. So a rough estimate is that $1.2 billion of their revenue is generated from those 32 million customers that are registered for their membership royalty plan. So I guess what I'm trying to say is that they have repeat customers that intentionally go out of their way to pick Papa John's over Domino's or even Pizza Hut. However, if you're anything like me, you're probably curious about why is their stock price going down, and there's a whole plethora of reasons, and they have headwinds that are brutal for them right now. Earlier this year, for instance, their CEO resigned, and the market did not like that at all. And I looked into it, and it was a pretty messy picture. He jumped ship to become the CEO at Shake Shack, which is that luxury burger brand that, in my honest opinion, it tastes good, but the portion size is too small and the burgers are just way too expensive. My goodness, the menu for Spain is just so big and so diverse. This is great. I just feel like Papa John's Mexico is going to be slapping booties. Let's see. Click on the menu and let that load. So what I'm trying to say is, if the CEO were to step down because of retirement, then nobody would care. But why would anyone do a lateral transfer for the exact same role at another company? Just think about it. I'm not trying to be negative, but maybe he has low expectations and hopes for Papa John's going forward, or he sees better returns from being the CEO of Shake Shack. It's common to see a vice president jump up to become part of the C-suite. Like, that's the next progressive step up the ladder in corporate America. Like a vice president of finance guy becoming a CFO at another company, or just moving up through the internal ranks. But for a CEO to run away from your company to join another one, not a good sign is all I'm trying to say. So the whole CEO situation right now is a hot mess. And not only that, unless you have been living under a rock, we are living in times of high inflation, which is negatively affecting a lot of the food businesses that are out there, because consumers are more and more likely to cook at home, because now they're realizing, why would I pay $15 for a Chipotle burrito when you could just make the exact same thing at home for $9? Can you imagine with me right now if in the US we were charging $129 for one pie? My goodness, that would offend me. But I'm assuming when you break this down and you convert the currency, it's probably like $29. I might be wrong. So speaking of $129 for one pie, I mean inflation, right? Which means the employee wages have to go up, and so do the menu prices. And when that happens, for a business, it can mean a more motivated workforce. But on the flip side, the customer can buy less of the product, because just 2 weeks ago, they're buying Subway sandwiches for $5, right? $5 foot long. And now they're expecting me to pay $12.99 for a foot long. Where I live, it's $12.99. I looked at the menu the other day and I just walked away. I said, absolutely not. And so if there's more people like me out there, they're probably just going to choose not to eat Papa John's, which in this case, it seems to be true. In fact, earlier this year, Papa John's has been closing down locations all across the UK due to profitability issues. Not good. So the bear case for Papa John's just writes itself. But let's try to end on a positive note. Let's figure out, do they have an economic moat? Well, I don't think so. They have intense competition from other pizza places like Domino's, Pizza Hut, and Little Caesars. When I think of those three, I see them as direct competitors to what Papa John's is doing. I don't care if they label themselves as premium or whatever. They're all in the same line of business, and the modality and delivery, everything just looks and feels the same. However, in my personal opinion, I think their indirect competitors is going to be Blaze Pizza and Mod Pizza. So as you can see, there's a ton of competitors in the pizza space, and it's because Americans and people around the world, we all love pizza. And does Papa John's do anything that separates them from the pack? Besides that little green pepper they give you and the dipping sauce, the garlic dipping sauce, I feel like the answer is no. So I would say they do not have an economic moat based on my personal experience and my research. And on that note, they posted their first quarter earnings not too long ago in May, and it was a mixed bag. So back in May, they reported their first quarter earnings, and their earnings per share beat the estimations. However, their top line and bottom line compared to the quarter of last year declined. Not a good look. So right here, their North America locations were down by 2% compared to last year, or 3%, depending on if it was a franchisee or a company-owned store. And then internationally, the exact same picture. However, they did open 8 new locations in North America, and they did post total revenues of $514 million for the past 3 months, but that was also down 2% compared to last year. And they're saying it's because less and less people are buying Papa John's. Even though the menu prices have gone up and their margins and their price per transaction has gone up, less people are buying. And then this right here is the financial callouts from the first quarter compared to last year's first quarter. So last year they posted $527 million. This year was $513. Their operating income went down. And I just think right now Papa John's is struggling. There's no doubt about it. And now we're going to be looking at the technical indicators to figure out what the stock price movement has to say about their future or what's going on right now. So I would say based on their trading pattern, they do seem to have a line of support around the $46 range, because for the past few weeks, they were just dropping steadily. And I'm determining that based on their lower Bollinger Band being $46. So if this stock goes below that $46, the gates are going to open and it's going to go on a bigger sell-off. But when we look at the 2-year picture, their RSI, their relative strength index, not looking good, right? So right now it tells me that Papa John's is absolutely oversold, because historically their RSI is around 58, 50 to 60. And when we zoom out to 5 years, you can see that their RSI even hovers up to like 73.2, as you can see right here. However, right now their RSI is sitting at 23. So they're being oversold, whether that's a good or a bad thing. There's fear in the market surrounding Papa John's. And this lower Bollinger Band says $40, but I think it's more accurate to say $46 is their line of support. Alrighty, friends, now we made it to my most favorite part of the video. Basically, we're going to run some calculations to figure out what the intrinsic value for Papa John's should be. So as a reminder, they're currently trading for roughly $46 a share. So the first one is going to be the multiples valuation. Essentially, we're looking at industry peers and seeing how the market values them. And when we take that into consideration, Starbucks all the way down to Domino's and McDonald's, the median PE ratio is 21.6. And when we look at Papa John's PE ratio, they are currently at 20.7. But on that note, their multiples valuation spits out $49 a share, which is an upside of $3 from their current trading price. The next one is going to be the discounted cash flow analysis model. Essentially, their free cash flow is going to tell us what the price for Papa John's should be. And when we look at their free cash flow, it is just really inconsistent and all over the place. And that's because of the pandemic. And because of that, I am going to give them a pass on their wonky numbers. But anyways, the average growth rate of their free cash flow for the past 5 or 6 years is 118%. That's bonkers. That sounds crazy. So instead, we're going to plug in 15% into the equation, because that's what the analysts believe their free cash flow growth rate should be for the next 5 years. So based on that 15% for 2024, 2025, 2026, and going forward, and looking at some balance sheet numbers, the DCF price for Papa John's should be $90 a share. And the next one is going to be the DDM. Essentially, the dividend and the growth thereof is going to tell us how much Papa John's should be worth in the future. Now remember, in their history and DNA, I think it was 2017 all the way to the mid 2021, they did not increase their dividend. Okay, so when I look at their past few years, yes, they have been aggressively increasing that dividend payment, but because they're going through some financial struggles and challenges right now, I am led to believe, based on their past actions that's really recent, they're going to stop raising those dividends until they can overcome the financial difficulties that they're going through. So realistically, I should plug in a 0%. But because the actual dividend growth rate is sitting at 21%, we'll be generous. We'll give them 4%. So the assumption is that going forward, that dividend is going to grow at a rate of 4%. So the DDM value for Papa John's is going to be $47 a share, which is $1 above what they're currently trading for. And the last one is going to be the Benny Graham's valuation model. And this one is going to say $27.83 a share, which brings us to the conclusion. What is the intrinsic valuation for Papa John's based on our forecasts and calculations? Papa John's is worth $53.87 a share, and they're currently trading for $46 a share. So based on our math, Papa John's is undervalued. And now I want to figure out what the Wall Street analysts believe the price target should be. And I forgot to mention, just a few days ago on June the 26th, an analyst actually slashed their price target for Papa John's from $55 a share down to $45 a share, which is why this past week, Papa John's has been going through a massive sell-off. The influence that these analysts have is just wild. But anyways, Wall Street believes that Papa John's is worth $69 a share, with the low estimation that we just saw of $45 and a high estimation of $90 a share. So we said 53, Wall Street says 69. I think that's a little too optimistic. This one seems more realistic with cynical numbers. So based on everything that I've seen, to be honest with you, it's a mixed bag, right? Papa John's is a hit or a miss. Honestly, I would rather just buy Texas Roadhouse or Domino's if I really want to buy a food stock, or McDonald's, right, if it's a real estate play. But for Papa John's, I guess I do see some potential in them. Do I see them going anywhere? No. Do I see them struggling this year? Yes. So with that said, I want to figure out an acceptable buy price. And in order to do that, I'm going to bake in a margin of safety. So right now, we're going to say that Papa John's is trading for $46 a share. With a 10% margin of safety baked in, then the acceptable buy price becomes $48 a share. But because Papa John's has such an uncertain future ahead of them, don't lie, right? For the next 3 to 9 months, Papa John's, it's inevitable, right? They're going to be trading sideways or even be trading downwards. So I would want more padding, more cushion, more of a margin of safety baked in, because 10% is not enough for a company that has a bleak future in the near term. In the next 10 to 20 years, I'm sure that Papa John's is going to be okay. But for the next year or two, not so good. So taking all of that into consideration, with their total returns of the past 10 years being negative, whereas 15 years it's positive, let's just go ahead and say we need to see at least the stock being on a 20% discount. With a 20% margin of safety baked in, then my acceptable buy price becomes $43 a share. And because Papa John's is a pizza company, I just can't help but naturally compare it to another investment that I hold, which is Domino's. And Domino's, believe it or not, is one of my most favorite dividend compounders with cheese. And unfortunately for Papa John's, I think Domino's is better than them in every single metric, even taste. I know that's a hot take and it might be an unpopular opinion, but I truly think that Domino's tastes better, their margins are better, their revenue, their expectations, just everything about Domino's is better than Papa John's. And the difference between the two, Domino's is on a bull run. So from the beginning of this year, Domino's has gone up by almost 25%. On the other hand, when we take a look at Papa John's has gone down by negative 38%. So when I think about Papa John's to Domino's, likewise, it's like comparing McDonald's to Burger King. McDonald's, unpopular opinion right here, I think it's the superior burger joint in their operations, marketing, brand, image, and franchise model. So for me, Papa John's reminds me of Burger King so much. It used to be a fantastic product, but it's just been going downhill. They need a turnaround story. Another restaurant that's just absolutely going through it right now is Cracker Barrel. Their brand, their image, their menu, and their customer base, just everything about Cracker Barrel, a lot of uncertainty with that stock as well. So for me, based on my math and forecasts, I can see that Papa John's is undervalued. I just don't think I'm going to be buying it right now. I am, however, going to be watching it from the sidelines, at a distance, maybe 20 feet, maybe 25 feet. I don't want to get too close because it's not that cute. But if it does keep dipping and it goes below that line of support that we talked about at $46 and it hits around $40 a share, then I might seriously consider jumping in. But as of right now, I just wouldn't do it. There's better opportunities in the market. Case in point, I would rather buy into Starbucks, McDonald's, or even Cisco than buy into Papa John's. But to be honest with you, if you buy into Papa John's, I can't blame you. Because if you have a long-term vision and horizon of like 20 years, Papa John's is going to be okay. I think what they're going through is a temporary setback of inflation just killing their margins and their business just going through a rough time. But in the grand scheme of things, I think Papa John's is going to be okay. However, I do do care about my returns for the next 12 months just as much as I care about my returns for the next 20 years. So that's why my reasoning is I would rather invest into Starbucks, McDonald's, or Cisco over Papa John's right now. Anyways, that has been a deep dive and an analysis and a review on Papa John's. Let me know what you think. I love you. Thanks for taking the time to watch this video, and I hope you have a good rest of your day. Bye-bye. Stay safe.